What's up, everybody? This is Lamine from investingsimplified.net. Today is Saturday, June 26, 2021. What a week compared to last week. As we indicated in our last week weekend video, we indicated that the sell-off market experience on Friday due to St. Louis Fed President Jim Bullard's statement was an overreaction. It played out exactly as we anticipated, except the fact that we were expecting market to bottom possibly Monday into Wednesday, but Friday happened to be the bottom. How did we know that? On Monday, market reversed, basically recouped all the losses on Friday, and it continued to push higher. S&P made a new all-time high. Nasdaq made a new all-time high. So without further ado, let's jump to the chart and take a look at the detail. Looking at the daily time scale of ES. As we can see, this red bar here, this pullback was resulted to Jim Bullard's statement on June 18th. Come this week, Monday, market basically reversed and recouped all the losses. And we indicated that this was an overreaction. Those people who were selling might not understand Fed policy and how Fed tend to communicate with the market. Our expectation was market should find a bottom either Monday, Tuesday, or Wednesday of this week. However, the low happened to be on Friday. Market came Monday. We basically recouped all the losses and plus some. S&P made a new all-time high and a new closing high as of Friday, June 25th. So what is our strategy going forward? Our strategy, we remain to be constructive. This has been our target for quite some time if you have been following us on YouTube channel. Expectation is S&P should come and tag this trend line. When that will be, we do not know. However, our expectation is S&P and other major indices should continue to grind higher, especially going into July. It tends to be pretty strong month from seasonality aspect. So if data comes out strong next week, hopefully S&P can find buyers that could potentially move the market towards this trend line that we have been targeting for quite some time. So let's say we happen to be wrong. S&P start to chop around and then roll over. Our first key level we'll be paying attention to is this prior high here. If markets start to break down that level, we'll monitor the 50-day and Friday and Monday's low, right around the 4130 zone, because this could be a bull trap here. We don't know. Market broke out, make new all-time high, new closing high, and all of a sudden it starts to roll over, especially if we start to make lower lows. That would indicate to us that we are wrong, and the likelihood of market coming to this trend line is very, very minute, and a potential pullback to even lower levels might be likely. But this is our playbook going forward. First key level to monitor going into next week is 4230 level. If that level breaks, watch the 50-day moving average and last week Friday's low and Monday's low, right around the 4130 zone. Looking at the indicator here, RSI is still not overbought. It's sitting right around 63 level. If market can find buyers, by the time we approach this trend line, we'll pay attention to the indicator and see if we are at or above the overbought zone. So let's jump to NQ and see where the key levels are. Looking at the daily time scale of NQ, we remain constructive as already discussed in the ES chart. Our target for NQ is this upper trend line here. Market is about 5.5% away from that level as of Friday's close. In the event we happen to be wrong, let's say market break this trend line here and the prior highs, then that will be a concern to us. Our expectation would be at that point a 50-day moving average, the 13758 level, needs to hold. If not, this is going to be a bull trap and it could be a very quick sell-off to the downside. Remains to be seen. We will continue to monitor, but until and unless we see the breakdown in the market, our strategy remain constructive. You don't have to be all in here or all out. Probably if you have been long, it might not be a bad idea to start to take some chips off the table, and then as market continue to grind higher, once we tag this upper trend line, then we can de-risk the portfolio and potentially look for buying insurance, for example buying put options or other strategies that can protect our portfolio. So looking at the RSI is not overbought yet, approaching the 70 level. ES is a bit farther away, but NQ is getting very close. By the time market tests this level, RSI should be in an overbought territory, which will indicate to us that a potential profit taking would be a good idea, and in the event of any sell-off. So with that, let's jump to the dollar index. Looking at the daily time scale of the dollar index, as we discussed in our last weekend video, that dollar index was at an overbought level and the likelihood of consolidation, if not outright pullback, was very likely. That's exactly what dollar index did. It pulled back for 2 days, and the last 3 days it started to consolidate right around key support level that we identified. This was a resistance. It acted as a support back in March, acted as a resistance in May. Now it's acting as a support. The question is this support going to hold? Thus far, it is holding. This is the 200-day moving average, lined up with a multiple zone that was tested as a resistance and support right around 91.50. Going forward, which way dollar index go will be very, very critical to the financial market. One, if we break to the downside, we will be more constructive in equity market and commodities. However, if dollar starts to find support here as it is thus far, if we start to break this 92.45 to 92.50 level, this trend line, that could be a potential bigger negative for commodities and equity market, especially gold and silver. Those two will be most impacted. So our strategy, continue to monitor this like a laser focus on the dollar index, because it will tell us a lot about the equity market and the commodities, because dollar has such a implication in the financial market. Since most commodities are priced in the dollar, foreign currency translation in the dollar, it can have an impact on some of those global firms, their revenues. So that's the reason why we pay attention to the dollar index. As long as this support level holds, our expectation is the path to least resistance, dollar could potentially start to grind higher here. As long as we don't make this rapid move, this 3-day move here, as long as it's like a grind move, perhaps financial market might be okay. My hope is dollar just don't come boom, 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 and we just start to break through this 92.50 and then we are straight up to 96 or 99 level. That will scare me. So that's what we are paying attention to. Hopefully it continues to consolidate here more, because looking at RSI, it's not at a level that is going to give me strong confidence that dollar is going to start to move straight up. If it can come down more, even towards this oversold zone, perhaps I'll say, okay, maybe if it starts to move higher, it will be much stronger. But time will tell. We'll continue to monitor and see what happens. So let's jump to the TNX. Looking at the US 10-year borrowing rate. The reason why we monitor this, one, it tends to be much accurate. It tends to tell us the truth, the reality about the economy far more quicker than equity market. Bonds react to information as it becomes available. Equities tend to discount information into the future. And as bond investors, they are not concerned about future cash flows. All they are concerned about is their principal and interest payment. That's why it's very critical and important to understand the bond market. And the US 10-year note is the borrowing rate that analysts use to discount future cash flows of corporations. You take the 10-year note, add your equity risk premium to come up with some kind of valuation. So that's why it's so important to understand what the bond market doing. It doesn't necessarily mean that you have to invest in it, but you have to understand the macro. So looking at 10-year note, the technicals, since back in March, we identified this potential negative divergence between price and momentum. As you can see, RSI has been making lower low while price was making higher high, indicating to us that there isn't much of a momentum behind this most recent move, and the likelihood of consolidation, if not outright pullback, was very highly likely, and that's what we got. It has been pulling back for the past few months, and it looks like we just might be finding a bottom here, and our expectation is 10-year notes should start to break above this trend line and then approach our upper end of our target into year end, 1.95. This is the level we have forecasted since last year, and that is playing out. This digestion, our expectation is to start to resolve to the upside. However, in the event we happen to be wrong, key level that we are monitoring on the 10-year note is 1.45 to 1.43. If that level gets violated, we let's say market rollover breakdown back test and the 1.45 to 1.43 level happen to act as a resistance, then that will indicate to us that the likelihood of further decline is likely, and that will tell us that something is wrong in the economy, and it will become our job to figure out what that is. Because if we see rates start to roll over here, that will indicate to us that one, the economy is either slowing down, two, the inflation expectation that everybody is worrying about is getting abated, and rates are sniffing it out much quicker than the equity market. So that will tell us how we should allocate our portfolio. But if our thesis plays out, especially if we take this upper trend line out, we will start to be more focused on value sector, financials, industrials, energy, and basic material. We probably get out of our tech trade because as rates push higher, it tends to impact long duration assets, and tech tend to be much more sensitive to higher rates. So with that, we will end the review here. We hope you enjoyed the video. If you did, please consider subscribing, share with your friends, and give us a like. Finally, anything stated here is our opinion and opinion only. It's not a recommendation to buy or sell any securities. Please consult with your financial advisor before you make any decision. And if you need help, you can subscribe to our premium content. We hope you all have a great weekend. Bye for now.